Continuing from the previous video, so previously we had our start for our journal entry, which was the acquisition or the establishment of the asset. Our journal entry was to debit the asset, whatever it might be. We said equipment last time, and credit cash. Our second journal entry is to show the use of the asset. Remember, we're recording this, capitalizing it as an asset. So it will sit on the balance sheet indefinitely until we show its use. To show its use, our journal entry is to debit depreciation expense and credit accumulated depreciation. Remember, accumulated depreciation is a contra asset account. It contradicts or offsets this asset right here, reducing it to provide its net book value. As you can see in this illustration, accumulated depreciation shows up on the balance sheet right here, and the depreciation expense shows up on the income statement here. To calculate net book value or property, plant, and equipment net, you take the original cost that we have minus accumulated depreciation, and this provides for you the net book value, sometimes just referred to as book value or sometimes referred to as the asset with a comma that says net. And this will be the amount that shows up on the balance sheet. Last class period, we discussed 3 different methods in which you could calculate depreciation expense, getting these X's that go in the journal entries right here. The methods that we discussed were straight line. Straight line is calculated by taking cost minus residual value, the value that you're not going to depreciate, and dividing by the useful life. And the useful life is measured in years, or time at least, in this method. It gets its name because if you were to graph it with years and expense, you would find that you take the same amount every single year, therefore producing a straight line. The second method that we looked at was units of production. Units of production is calculated by taking cost minus residual value, again subtracting out the value you're not going to depreciate, and dividing by total estimated units produced over the life of the asset. Here we're measuring the life, the useful life of the asset in units produced rather than in time. This is then multiplied each year by actual units produced. And we use that term produced liberally because it could be units produced from machinery. For instance, if you're creating goods, it'd be how many goods are produced. But it also could be units consumed. For instance, if you're driving a vehicle, it could be miles driven. Our third method is double declining balance. This is calculated by taking cost minus accumulated depreciation, not residual value, and then multiplying this by 2 over the useful life measured in time. This method gets its name because if you were to graph it and put years and expense here, you'd find it has a downward slope. It takes up the most use in the beginning years and then sort of trails off as we progress. There are a few things to watch out for when calculating double declining balance. Number 1, it uses accumulated depreciation, not residual value, like the other 2 methods. Number 2, still can't depreciate residual value. So you have to manually check for residual value. The other 2 methods take residual value out, so you couldn't possibly depreciate it. It's not part of what we call the depreciable base. But in the double declining balance method, we don't remove residual value, so we have to manually check for residual value to make sure we're not depreciating past that amount. And finally, remember that in first year of double declining balance, accumulated depreciation is 0. Notice every time we do these calculations, we are getting this journal entry here, and part of this journal entry is accumulated depreciation. So in the first year of double declining balance, your accumulated depreciation that goes into this calculation is 0 because you haven't yet calculated the amount that would go into this journal entry. That is not utilized in the other methods. It's not that every first year accumulated depreciation is 0. It is just in this method, the first year's component into the calculation for accumulated depreciation is 0 because we haven't calculated accumulated depreciation yet. Finally, do remember that accumulated depreciation truly does accumulate. So remember, you have to keep a running tally. Accumulated depreciation will get bigger every single year. The journal entry, right, will be a single amount, but accumulated depreciation accumulates in its T account. So you add year 1, then you have 2, then you have 3. And so when you're taking out years 3 accumulated depreciation in this calculation here, make sure you're taking this total here, not just year 3 amount. Notice that regardless of the method that you use, ultimately they all end up having the exact same in total accumulated depreciation. We depreciate the depreciable base, the cost minus the residual value, regardless of the method that we use. We just have to manually check for it in the double declining balance. You can see the double declining balance, it's in the orange here. It decreases every single period, declining. You can see that the straight line amount is the same every single period. And then you can see units of production in the green varies based upon units consumed or produced each period. One item we want to address is partial period depreciation. It's important to note that the calculations that we were doing previously, when utilizing those calculations, typically what we're doing is calculating depreciation expense for a full period, but sometimes we don't put the asset into use for a full period. This is particularly important when you consider measuring useful life as a basis of time. So for instance, if we purchase an asset on 6/30, and we calculated a full year's depreciation expense under straight line method by doing cost minus residual value, and we divided by time, useful life. And let's say we measure that useful life in years. So let's say it was 5 years was the useful life, so we divided by 5. Well, whatever our calculation, let's say this above is 10, and this gives us 2,000 per year. This is 2K per year, but we purchased it at 6/30, which means the asset wasn't in use for the full year, which means we can't depreciate all 2,000. Instead, we have to take the 2,000 and multiply by the fraction of the year that it was outstanding. In other words, 6/12. So we have 1,000 to depreciate for this first year's depreciation. So remember, with partial period situations here, you have to take into consideration how long the asset was outstanding. Typically, this does not apply for units of production, and the reason why is because units of production represent actual units that we've produced or consumed during a given period. Thus, it naturally is adjusted for partial period. For instance, if you're only working from July 1st to December 31st, then that means you're not going to be able to produce as many units. Thus, it makes sense that you've already adjusted the number for the partial period. However, when you're measuring in time, like straight line or double declining balance, typically we have to make this adjustment. The final journal entry that we'll have for the tangible asset is the disposal of the tangible asset. That journal entry will get rid of the asset, take it off its books. To do this, we debit accumulated depreciation, credit the asset itself, and then we consider whether or not we received any cash. If so, we debit cash if we're disposing of the assets, if we're selling it or scrapping it and receiving some sort of cash for that. And then we potentially have either a gain or loss depending on the result of the cash that we have versus the net book value. So we could have a gain on disposal, which this gain account is treated similar to a revenue account. It increases the income on the income statement. Or we could have a loss on disposal. A loss on disposal is similar to an expense on the income statement. It reduces net income. The difference between gains and losses is where revenue and expenses are for operating purposes, gains and losses are for auxiliary or peripheral operations. Okay, so journal entry would look like this. But the thing to note is that this and this are an either or none. They're not both, okay? So you'll either have a loss or a gain or neither, but you won't have both in the same disposal. Here's an example of how you calculate your gain or loss. You first consider the proceeds that you're receiving. This is the cash that you're receiving, and compare that back to the net book value. The net book value, remember, is calculated by original costs minus accumulated depreciation. And then if your cash proceeds that you receive is more than the net book value, then you have a gain on disposal. If it's less, then you have a loss on disposal. One quick note to mention is that typically prior to doing your disposal journal entry, you must do a depreciation journal entry to do what we call true up the depreciation on the asset prior to the sale. So if there's any depreciation you haven't recorded yet and you're about to sell the asset, you have to first do this journal entry to record any missing depreciation, then you will do the disposal.